basically everything you need to know as results to trading strategies. And of course, in the past times, we have been talking about various things as regards forex anatomy, I mean to say, and as well as also we are talking about the breakdown about the forex strategies that you need to learn. Today we'll be having quick insight on how to trade double tops and double bottoms, how to trade head and shoulder patterns, how to trade wedge patterns, how to trade bearish and bullish pennants. So just stay on with us while we take you on this very important strategies that can help maximize your profit potentials. Next page, please. So how to trade double tops and double bottoms? We see that double tops are very important strategies when it comes to maximizing profit potentials. Of course, I want from the diagram above, and we're seeing a downtrend, and we saw a bit of a push up back to the neckline. And of course, the double top is more like a reversal pattern that is formed after there is an extended move up. The tops are peaks, which are formed when the price hits a certain level that can be broken. So after hitting this level, the price will bounce off it slightly and then return back to the test level again. If the price bounces off that level again, then you definitely have a double top. In that chart above, you can see that there are two peaks of the tops were formed after a strong move up. And you notice, of course, that there was a slow decline by the first retracement candle. You notice how the second top was not able to break the high of the first top. This is a strong sign that a reversal is going to occur because it is more or less telling us that the buying pressure is just about finished. And with the double top, we could also, place our entry right down below the neckline. And because we are anticipating a reversal of the uptrend. Next page, please. So here is another double top example. And we must always understand that double top are very important. They come in different ways. So you're looking at the chart, you can see that the price breaks the neckline and makes a nice move down. You should remember that double tops are a trend reversal formation. So you want to look for these after there is a strong uptrend. You also notice that the drop is approximately the same height as the double top formation. So you should always keep that in mind because it is very useful in setting profit targets. So you take, for instance, we saw a neckline at this double top, and then we saw price drop down. in various places. And we first saw the first initial candles, and then we saw a follow-through candle right after the breakout from the neckline. So at this point, we should have made every trader will make a very important entry and closing massive profits, because that's more like what we call the money spot. So once the breakout happens from the neckline, we make it down to the point where you have that very important spot. Next page, please. The double bottom. Now, the same way we have double tops, we also have double bottoms. The double bottom is also a trend reversal formation, but this time we are more or less looking to go long instead of short. And these formations occur after extended downtrends when two valleys or bottoms, have been formed. And you can see from the chart above that after the previous downtrend, the price formed two valleys because it wasn't able to go below a certain level. And you notice how the second bottom wasn't able to significantly break the first bottom. And of course, this is a sign that the selling pressure is about finished and that a reversal is likely about to occur. So you take, for instance, the two bottoms, the first bottom and the second bottom. So we have a lot of things to understand from this. Once we notice the second bottom touching the same support zone and the pushback happens, it's very ideal to make an entry right at this point. To the next page, please. Now, the price broke the neckline at that point and made a nice move up. So see how the price jumped by almost at the same height as that of the double bottom formation. Now remember, just like double tops, double bottoms are also trend reversal formations. You want to look for these after a strong downtrend. So let's take a look at this. We have the price moving up at the neckline. We see a lot of people who are trying to make entries. The first candle right after breakout of the neckline. I'm guessing a huge amount of traders made entries and then closed out and made a profit, feeling that the market was dying in momentum. But then it kicked up back and the price moved up just after retesting the very important double bottom section. So remember, just like double tops, double bottoms are also trend reversal formations. And you want to look for these after a strong downtrend. To the next page, please. How to trade the shoulders, the head and shoulders pattern. Head and shoulders, the head and shoulder pattern is also a trend reversal formation. Now, we always have what we call double shoulder with head pattern, and it's just more like a human being with a head and two shoulders. So if you notice a chart that has something similar to this, a head, two shoulders, and of course a neckline, you see the two shoulders at this point having let's say for instance you see that point and this point and then the point up there, the head. It is formed by a peak shoulder followed by a higher peak, and then another lower peak. The neckline is drawn by connecting the lowest points of the two toes, and the slope of this line can either be up or down. Typically, when the slope is down, it produces a more reliable signal. So we are seeing two shoulders and a head. We have necklines, we have uptrends currently happening, and then you see the double shoulders and the head, and then you see the red candle that formed right after these two shoulders and head pattern formed. And then you should understand that what a sell market is actually in the books. And at this point, it's a good time to make some entries for a sell, and closing good profits. To the next page, please. Now, in this example, if you had followed this double shoulder with head pattern, the head was the second peak and is the highest point in the pattern. The two shoulders also form peaks that do not exceed the height of the head. With this formation, you go ahead and put an entry order below the neckline. We can also calculate the target by measuring the high point of the head of the, to the neckline. And the distance is approximately how far the price will move after it breaks the neckline. You can see that once the price goes below the neckline, it makes a move that is at least the size of the distance between the head and the neckline. Of course, I should understand what you're thinking. The price kept moving even after it reached the target. And our response is do not be greedy at this point. But once you notice this, you make more entries and you secure more profits. So if you had made an entry right after you noticed that and saw the market dip down, you would have made quite a whole lot of money from that entry. To the next page, please. Now, the inverse head and shoulders, the name speaks for itself. It is basically a head and shoulder pattern, except this time it's an upside down. You understand? A valley is formed, followed by an even lower vol valley head, and then another higher valley. And these formations occur after extended downward movements. You see a downtrend happening. You see double shoulders with head patterns, and then a reversal upwards. You should understand that it is way, way, way moving ahead of the market. So you see two shoulders, and then you see an upward movement, and it's pure trend reversal. A valley should be formed right after the shoulder, and it should be followed by even a lower valley head, and then another higher valley shoulder, just as we have explained. And right after that, you see the boom to the upside, continuation for an uptrend. To the next page, please. Now, here you can see that this is just like a head and shoulder pattern, but it flipped upside down. With this formation, we will place a long entry order above the neckline. Our target is calculated just like the head and shoulders pattern. Measure the distance between the head and the neckline, and that is approximately the distance that the price will move after it breaks the neckline. You can see that the price moved up nicely, and after it broke the neckline, it was a very upward movement, having two gigantic candles. These are Marubozu candles, of course. And once you notice this, you should understand that this price shoots ups happening. Clear spot for making money is called the money spot, of course. So if your target was hit, and then you should be happy with your profits at that point. However, there are trade management techniques where you can lock in some of your profits and still keep your trade open in case the price continues to move your way. You will learn about this later on in the course of what you're doing. So it's ideal that you understand everything we are doing. You follow through with every strategy we're dropping here. So this is more like what we should understand about double shoulders with head patterns for the reversal side for the uptrend. To the next page, please. How to trade wedge chart patterns. This is a rising wedge. The rising wedge is formed when price consolidates between an upward sloping support and resistance line. Here, the slope of the support line is steeper than that of the resistance. This indicates that higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. So when prices are consolidating, we know that a big splash is coming, and we can expect a breakout to either the top or the bottom. Now we have highs and we have even higher lows. We have uptrend, we have higher highs, we have even higher lows. So when they are very important at this point, you draw your rising wedge line, downwards and upwards, and then you have all these things ready. And once you've spotted this uptrend, it's very important to keep these things alive by making things very proper, having a closer look at your wedge lines, making sure there are no breakouts yet. But then if the breakouts are preparing, you make sure you hit the top once it breaks out from that rising wedge pattern. To the next page, please. To the next page, please. Not this one, the next one. Right. Now, right about now, if you had drawn your wedge pattern then and you saw a breakout from the sell zone, see how price broke down to the downside, that means that there are more forex traders than belong. Now, they push the price down to break the trend line, indicating that the downtrend may be in the cards. So, just like in the other forex trading charts, patterns were discussed earlier, the price movement after the breakout is approximately the same magnitude as the height of the formation. So let's take a look at another example of a rising wedge formation. Only this time it acts as a bearish continuation signal. So price makes a nice move downwards, and then between that point of your entry and the point of the next support, you gathered like, let's say 50 to 60 or 70 or 100 pips thereabout, and of course you made good money from that entry point. To the next page, please. Now, as you can see, the price came from a downtrend before consolidating and sketching higher highs and even higher lows. So in this case, you saw the first wedge pattern was drawn. Now the price broke to the downside and the downtrend made a continual movement. That's why it was called a continuation signal. We can understand that price made a nice move down. That's the same height as the wedge, and a rising wedge was formed after an uptrend, which led to a reversal downtrend, while a rising wedge formed during a downtrend typically, which resulted in a continuation downtrend. So we simply put a rising wedge that led to a downtrend, which means that it's a bearish chart pattern. So we're always talking about how we can make these moves, how we can understand these things. So when we are seeing much more downward pressure, we should understand that it's not something that can just be guessed. No, once you have drawn your wedge pattern and you see the way things are moving, you should understand that these things are very, very ideal when it comes to having a good strategy with this method of trading. To the next page, please. We have the falling wedge. Just like the rising wedge, we have the falling wedge, which can either be a reversal or continuation signal. We see a reversal signal formed at the bottom of a downtrend, indicating that an uptrend would come next. Now, as a continuation signal, it is formed during an uptrend, implying that the upward pricing action would resume. Unlike the rising wedge, the falling wedge is a bullish chart pattern. Now, in this example, the falling wedge serves as a reversal signal. After a downtrend, the price has already made lower highs and lower lows. We notice how the falling trend line connecting the highs is steeper than the trend line connecting the lows. So for a downtrend, we notice lower lows, we notice lower highs, and then much more downtrend happening, falling. We should understand that it has to do with a lot of technicality, because it was clearly nearing a very important support zone, and at this support zone, we should know that either a bounce back was going to happen or total fall through a breakout from that support zone was going to happen. To the next page, please. Now, upon breaking above the top of the wedge, we can say that the pair made a nice move upwards that approximately equal to the height of the formation. In this case, the price rally went a few more pips beyond that target. Now, let's take a look at an example where the falling wedge serves as a continuation signal, like we mentioned earlier. When the falling wedge forms during an uptrend, it usually signals that the trend will resume later on. Now, in this case, the price consolidated for a bit after a strong rally. And this, of course, could mean that buyers simply paused to catch their breath and probably recruited more people to join the bull camp. Now, it looks like the pair is revving up for a strong move. Which way would it go? We are assuming it's going to go downwards, right? Of course, because we have drawn a lower wedge pattern. But then let's see what happened right after the uptrend. To the next page, please. Now, we can see how the price broke to the top side, and then it went up to climb higher. And if you had placed an entry order above that falling trend line, connecting the peer highs, we would have been able to jump in on the strong uptrend and cut some pips, of course. Now, a good upside target would be the height of the wedge formation. If you want to go more for more pips, you can lock in some profits of the target by closing down a few portion of your positions. Then you let the rest of your positions to ride. So this is an example. Drawing your lower wedge pattern, a breakout, a very important resistance, a thorough breakout, and a push up to the upside more and more. The next page, please. Now, we have what we call the rectangle chart patterns, which are used for trading breakouts. Now, a rectangle is a chart pattern formed when price is bounded by parallel support and resistance levels. We see a rectangle exhibit a period of consolidation or indecision between buyers and sellers as they take their turns trading punches, but neither has even taken over. And the price will test the support and resistance levels several times before eventually breaking out. From there, the price could trend in the direction of the breakout, whether it is to the upside or downside. The next page, please. Now, we can see three important support zones. In the example above, we can clearly see that the pair was bounded by two key price levels, which are parallel to one another. We just have to wait until one of these levels break and go along for the ride. Now, remember, when you spot a rectangle, always think outside the box. When you spot this wedge pattern, you put your very important support zones and also mark out the resistance zones. Now, if the price is keeping looks like it's pushing upwards, breaking above the resistance, you wait. Always wait for the retest, or you wait for the confirmation candle after the retest. And when the retest happens, you see it sprouting, shooting up right after the breakout of the resistance. Of course, that's a good time to make an entry and secure some profits. Next page. Similarly, we have what we call the bearish rectangle. Now, a bearish rectangle is formed when the price seemingly consolidates for a while during a downtrend, and this happens, of course, because sellers probably need to pause and catch their breath before taking the pair any more lower. Now, you've seen a downtrend, you've seen example of a consolidation. We use our rectangular bearish rectangle. We mark it out, showing the consolidation part, and then price falls by the same height and more, and you see a lot of downtrend. In this example, the price broke the bottom of the rectangle chart pattern and continued to shoot right down. If we had a short order just below the support level, we would have made a nice profit on this trade. Now, here's a tip. Once the pair falls below the support, it tends to make a move that is above the size of the rectangle pattern. And in the example below, or rather above, the pair moved beyond the target so that there would be a chance to catch more pips, seemingly make more profits. Next page, please. To the next page, please. How to trade bearish and bullish pennants. Now, just like you have the rectangles, pennants are continuation chart patterns formed after strong moves. After a big upward and downward move, buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. Because of this, price usually consolidates and forms a tiny symmetrical triangle, which is called a pennant. While the price is still consolidating, more and more buyers or sellers usually decide to jump in on the strong move, forcing the price to bust out of the pennant. Formation. Now, a bearish pennant is more or less formed during a steep, usually always vertical, downtrend, after the sharp drop in price. Sometimes sellers will close their positions, while other sellers will decide to join the trend, making the price consolidate for a little while. Next page, please. Now, we've seen a downtrend, and as soon as enough sellers jump in, the price breaks below the bottom of the pennant and continues to move down. We see a brief consolidation. For instance, you draw your wedge pattern to the upside and the downside. To the next page, please. Now, right after you draw your trend line, or rather your wedge pattern, as you can see, the drop resumed after the price made a breakout to the bottom. Now, for you to be able to trade this kind of chart pattern, you put a short order at the bottom of the pennant with a stop loss above the pennant. That way, we'll be out of the trade right away in case the breakdown was a fake out. Unlike the other chart patterns wherein the size of the next move is approximately the height of the formation, we have pennants signal much stronger moves. Usually the height of the earlier move, also known as the most or mast, is used to estimate the size of the breakout move. So once you see that, having mapped out your wedge, you wait for the proper breakout. And once that breakout happens, you see what went through. The downtrend resumed, flushing down so much. So anyone who had drawn their wedge pattern very well and waited for the proper breakout should have racked enough pips. To the next page, please. Now, similarly, we have what we call the bullish pennant. The bullish pennant, just like its name suggests, signals that bulls are about to, go charging again. This means that the sharp climb in price would resume after that brief period of consolidation, when bulls will gather enough energy to take the price higher again. Now, in this example, the price made a sharp vertical climb before taking a breather. We can hear that the bulls stomping and arriving up for after another run. Now, when you see a consolidation like this right after the uptrend, it's very ideal to make sure that you have your wedge patterns closely drawn, just like you can see. Now, once after the consolidation point has happened, always wait for the breakout candle. Always wait for the breakout candle. Next page, please. Now, see what happened right next. Just like we had predicted, the price made another strong upward move with a Marubozu candle after the breakout. To play this, we'll place our long order above the pennant and our stop below the bottom of the pennant, of course, to avoid a fake out. A fake out is something like a boom to the top and then a retracement. But like we discussed earlier, the size of the breakout move is around the height of the mass for the size of the earlier move. You can see pennants may be small in size, but they could signal huge price moves. So don't really underestimate them. They are very important moves, and they can help secure a lot of profit at any given time. To the next page, please. So that's all for today on the Forex Guru Trader. I believe we have learned a lot so far from inception right up to this point. And we have more in stock for you when it comes to the educational system on ZTradex. And I believe you're always looking forward to it. So see you again same time next week.